Is artificial intelligence the greatest wealth creator in history? Or is it a speculative bubble waiting to burst? The markets are currently divided. On one side, tech giants are investing hundreds of billions, claiming we are at the dawn of a new industrial revolution. On the other, skeptics point to skyrocketing valuations and a lack of clear profitability, calling it a repeat of the 2000 dot-com crash. Today, we aren't here to pick a side. We are examining the raw data, the circular money flow, and the massive capital expenditures. Is this a new era of growth, or a financial balloon? Let's look at the facts and you can decide. I'm Yorla. Let's get started. Calling AI a balloon refers to the concept of an economic bubble, a phenomenon where hype and investment inflate the perceived value of a technology far beyond its current utility. Just like a physical balloon, the AI market is currently expanding rapidly as billions of dollars pour into startups and infrastructure. This metaphor highlights the thin walls of market sentiment, where unrealistic expectations such as achieving human-level intelligence overnight could eventually lead to a pop, or a sharp market correction if profitability doesn't match the massive spending. As of early 2026, many experts are debating whether we are in a sustainable boom or a fragile bubble, noting that while the technology provides real value, the sheer scale of debt-funded investment creates systemic risk. However, even if the balloon deflates, history suggests the underlying technology will likely survive and mature into a more grounded, practical industry. The term serves as a warning that what goes up based on excitement alone must eventually be supported by solid economic foundations. The dot-com 2.0 debate focuses on whether the current AI surge is a sustainable revolution or a repeat of the 1990s speculative mania. While the enthusiasm feels familiar, the financial structures of 2026 tell a more complex story. Comparing the foundations of the late 90s internet craze to today's high-stakes artificial intelligence infrastructure boom. The 1990s were defined by vaporware startups with no revenue, reaching massive valuations. In contrast, today's boom is driven by hyperscalers like Microsoft and Google, who use massive cash reserves to fund growth. Unlike the debt-heavy 90s, these giants are highly profitable. Examining the potential risks of overextended capital expenditure and high valuation multiples in the current market cycle. Despite stronger balance sheets, red flags persist. Infrastructure spending is projected to hit $500 billion this year, creating a debt-fueled arms race. If AI products don't deliver immediate returns, the high price-to-earnings ratios could lead to a sharp market correction. History suggests that even if the financial balloon pops, the underlying technology usually remains. The key question is whether the current investment can transform into long-term profit before investor patience expires. The circular money glitch, or circular financing, is a financial loop where a few massive companies pass the same billions of dollars back and forth to keep the AI hype machine running. It is essentially a game of economic hot potato that creates the illusion of explosive growth. The self-feeding loop of tech giants and startups. In this cycle, a giant like Nvidia or Microsoft invests billions of dollars into an AI startup like OpenAI or CoreWeave. Instead of using that money to pay employees or build new inventions from scratch, the startup immediately hands that same cash back to the investor to buy high-end chips or cloud computing power. The investor then reports this as record-breaking revenue, which drives their stock price even higher, giving them more cash to reinvest in the startup. The hidden risks of a financial mirage. The danger is that this growth isn't coming from outside customers or real-world productivity yet. It's coming from the company's own bank accounts. Americans should understand that if the glitch stops perhaps because a startup runs out of new investors, or the chips don't produce a profit, the entire loop can collapse like a house of cards. While it looks like an infinite money trick on paper, it relies on the hope that AI will eventually make enough money to pay back the trillions being shuffled around today. While the balloon or bubble theory is popular, many experts argue that AI is a foundational shift rather than a repeat of the 1990s speculative craze. They suggest this time is fundamentally different for three key reasons. Real profits versus .com vaporware. Unlike the 90s, where startups with no revenue went public on a prayer, today's AI boom is led by hyperscalers like Microsoft, Google, and Nvidia. These aren't fragile startups. They are profitable titans with massive cash reserves. They aren't betting with borrowed money, they're reinvesting real profits into physical assets like data centers and chips. Measurable productivity gains. This isn't just hype, it's a utility. Recent 2025 reports show that workers using AI are saving an average of 5 to 7 hours per week. In fields like software coding and customer service, productivity has jumped by 14% to 55%. Companies are seeing immediate cost reductions, making AI a must-have tool to stay competitive rather than a luxury. Physical scarcity versus overcapacity. In a typical bubble, there's too much of everything, like the dark fiber excess of 2000. Today, we have the opposite, a massive shortage of GPUs. When demand outstrips supply so drastically, it suggests the value is grounded in real-world necessity, not just hot air. A bubble pops when the gap between a technology's hype and its actual profit becomes impossible to ignore. In simple terms, it's the moment investors realize they've spent trillions on a magic tool that isn't paying the bills yet. The show me the money moment. For AI, the pop could be triggered by disappointing earnings. Right now, tech giants are spending roughly $180 billion a year on AI chips and data centers. If companies don't see a massive jump in their own revenue from using these tools, they will stop buying chips. When the buying stops, the stock prices of the winners, like Nvidia, could come crashing down. The chain reaction of fear. Once the big players pull back, a panic sell-off usually follows. Just like a game of musical chairs, everyone tries to exit the market at once to avoid being the greater fool, left holding worthless stocks. High interest rates can make this worse, as the cheap money used to fund these experiments dries up, forcing companies to face the cold, hard reality of their bank accounts. To sum up, is AI a revolutionary supercycle, or just another balloon waiting to pop? While it echoes the dot-com era's gold rush energy, the foundations are different. Today's boom is led by profitable giants with deep pockets, not just revenue-free startups. The financial loop. However, cracks are forming. We are seeing a circular money glitch, where tech giants invest in startups that immediately hand that cash back to buy chips and cloud space. This inflates revenue numbers without a single outside customer. The turning point. The bubble pops when this infinite money trick stops. If AI doesn't deliver a clear return on investment soon, the high spending will dry up, triggering a panic sell-off. Whether it's a solid bridge to the future or a fragile balloon, the next year will decide if AI can finally pay its own bills.